Dear friends, welcome to Module 1 of Microfinance. In this module, we will learn about the basics of microfinance. We will see what is microfinance, why is it important, what kind of companies do microfinance, what is group lending. What is microfinance? Microfinance is a way in which loans, insurance, access to savings accounts, and money transfers are provided to small business owners in the underdeveloped parts of India. The beneficiaries of microfinance are those who do not have access to these traditional financial resources. Many of the people who avail of microfinance are women who run small businesses from home. The concept of microfinance was started by Muhammad Yunus from Bangladesh. He was the founder of Grameen Bank. His work is now being used in many countries across the world. He was honored with the Nobel Prize in 2006. What are the types of microfinance? Microfinance includes the following products. Microloans. Microfinance loans are provided to borrowers with no collateral. These help the borrowers start and run their small businesses. Many of them then become ready for larger bank loans. Micro savings. Micro savings accounts allow small business people to operate savings accounts with no minimum balance. These accounts help the account holders in financial discipline and develop an interest in saving for the future. Micro insurance. Micro insurance is a type of coverage provided to borrowers of microloans. These insurance plans have lower premiums than traditional insurance policies. In some situations, recipients of microloans are expected to take some training courses such as cash flow management and bookkeeping. Why is microfinance important for our country? Almost half of the population of our country does not have a basic savings account. However, these poor people require financial services so that their dreams such as building of assets like houses and bank balances are fulfilled. It helps them plan for the future. Microfinance provides access to capital for individuals who are financially underserved. If microfinance institutions were not offering loans to this segment of the society, these groups would have resorted to borrowing money from friends or family members at very high interest rates. Microfinance helps these groups invest wisely in their businesses. This helps in the financial inclusion process for millions of people in India. What are some of the key features of microfinance? Some of the significant features of microfinance are as follows. The borrowers are generally from low-income backgrounds. Loans availed under microfinance are of small amounts, that is microloans, which can range from few hundred rupees to a few thousand rupees. The tenure of the loans is short. Microfinance loans do not require any collateral. These loans are usually repaid at higher frequencies. The purpose of most microfinance loans is income generation. What are microfinance institutions, MFIs? MFIs have microfinance as their primary operation. These lend through the concept of joint liability group, JLG, that is an informal group that consists of 5 to 10 members who seek loans either jointly or individually. A microfinance institution specializes in banking services for low-income individuals and groups. These institutions access financial resources from mainstream financial entities and provide support service to the poor. Microfinance institutions are hence emerging as one of the most effective tools of reducing poverty in India. What type of institutions can offer microfinance? The different types of institutions offering microfinance in India are commercial banks, credit unions, non-governmental organizations, NGOs, sectors of government banks, cooperatives. In this course, we will speak mainly about banks. Apart from offering loans, financial services such as insurance, savings, and remittance are provided. Non-financial services such as training and advice and supporting borrowers are offered in the most convenient manner as well. Why are interest rates for MFIs higher than normal bank loans? The rate of interest charged by microfinance institutions, MFIs, are higher as compared to those levied by banks, as it is more expensive to process smaller loans as compared to loans offered by traditional banks. Most of the applicants who apply for MFI loans reside in rural areas, due to which the cost of operation is high and hence the interest rate is also high. Also, the loans are without collateral, so the lender cannot recover anything if the borrower is unable to pay. What is group lending? Group lending is a common practice in microfinance. Rather than lending to individuals, MFIs usually lend to small groups of people who come together to borrow money and ensure timely repayment of the loan. This group-based approach has many advantages. More people tend to come forward and take a loan when they are part of a group. Also, peer pressure ensures that every member of the group repays. From the lending institution's point of view, lending to groups usually proves more cost-effective, since the cost associated with each loan is reduced by lending to groups. Also, usually there is no need for collateral if the loan is made to groups. What is a joint liability group? In your work, you will hear a lot about joint liability group or JLG. A joint liability group is usually a group of 5 to 10 people who come together to borrow from an MFI. The members in a JLG are also from similar social and economic backgrounds and usually from the same village. In a JLG, the members share liability. It means they stand guarantee for each other. If any of the members default, the other members need to pool in the money to repay the MFI. This ensures a greater effort on part of the members to make sure that everyone repays, thus resulting in better accountability and security for the MFI involved. Let's come to the summary and conclusion. This finishes Module 1 of our course in Microfinance. In this module, we learnt what is microfinance, why is it important, what kind of companies do microfinance, and what is group lending. In the next module, we will learn some basics of banking in India. Thank you.